Here we are, we just opened up, and here is the equity price printing at 538.40. The gap down in pre-market was down around the 534 handle. We can see because the way that they lift the bar on the opening bell at 538 that you're not getting much premium here. None at all. Close at 10:30, 1950. It's 1930 by 1990. This side of the market was the put side of the market. Would be the side of the market. You know why? Because Google, this is a 540 put, but look at 1542 was the close. So what is going to be the quickest side of the trade here is that this side's going to inflate up. This side here, they're got a bid and an ask of 40 pennies wide on the opening bell price print, based on 48,000 share count, based on a minute on the opening bell, with a minute opening bell option, bid and ask on 540. 530 call was deep in the money. 530 call, they only make one contract print. Now, this is going to be the wholesale side of the market. All right, 1550 by 16. Because as Google reverses, you want to be buying here first. Brian Plain, you would do one contract at 60 cents and work the bid and ask. We can see right now that the MMT is being taught how to take the entry by keeping the bid low. So go back and put the bid. I just told Mr. Plain 1550. If they throw off to you, then you get to be over here and put it out to sell at 1710. You can control the bid and ask and everything that they do. But now let's take a look at the opening bell here. We're only down to 530, 541, and we bounced $2. And this is holding a higher bid, and this side of the market, in the money call, the premium is being deleted. So as we finally do hit a support level for this side of the tape, we would have lower bids below this market here, and we will apply the 3-minute chart for the entry. We will examine that bid and ask. 1830, throw one contract out there at 1850, Mr. Plain. Right now, why it's teeter-tottering in here. I'm going to pull up my market maker chart. Here we have a bid at 1850. There's only one contract. They printed a 1950 on the tape. Over here, they printed a low, the 540 put, at 16 versus its 1542 close. There is no premium yields. So when there is no premium yield, we always keep in the lower end of the bid, as we are watching down here the 3-minute chart in our market maker platform over here. Now we're going to keep that lower bid, because if they hit us over here, then we get to come over here and offer out as a market maker in the option. How nice. But we got to monitor the heartbeat. So they created $16 spread. There just isn't going to be much created. We've only been open 4 minutes in the price spread in 82,000 shares. You can clearly see that the low is 535. You can clearly see that the highs were put in at 538.73 and a low spread. Same low that we've seen in pre-market. Price spread is 39 cents. When you have a price spread of 39 cents, you'll be looking at this over here and that over there. That's the put and the call. And the thing about it is, the wider the spread, when it prints on one side of the market, it makes a little adjustments over here. So because you can see a 1950, you can see the bid and ask here. You can see the bid and ask here. And we have a low bid below the market to buy that, and we have a low bid to buy this during this little up and down weasel move that they're doing in 5 minutes on the opening bell. We can clearly see that the IR is elevated. We can clearly see that the ratio, as it populates, here it is.
I am long the TNA, and I'm also short the TZA.
This is how to square this side of the market and this side of the market relative to the light volume and the current opening resistance and support and resistance relative to the close of 539 now. And that if we fail here and do not go above 75, then we are going to go down here and these are going to go up in value here, and we will monitor the heartbeat here. We know that 0.62 was the low of the day, which equaled 9.917. He's at $3.67 relative to how they're pricing the premium in that call and pricing the premium over here based on using minus 3.67 in the system. This line of code right there is applicable here and applicable there. Okay? And then mathematically figuring out what the premium is, which we've already done. So basically, as we move up, we're going to take this put option, this 540 put option, down in its price right now to a bid of it'll be $13.90 now on this side. As they still premium over here, 19 is a new low, and they're not doing much even in the price. This is not going up in value. We will drop this value of this call option down to $18.20 for right now. During the opening bell, sideways action on low volume, waiting those entries just like I said, and then we'll revisit it here in a few more minutes. You're getting a diamond pop. I'm getting a diamond pop. That's verification. And we have a lower bid here. They're not giving premium here. Closed at 20.30. 20.30 to the bid is 19.20. 80, that's a 60 penny wide. What am I working on is where that spread's going to be created. And why am I getting a bid pop and I'm not getting deserving premium over here on the call, which is in the money? And I have a lower bid because that premium is not printing the right way. And even that 540 premium for the bid pop, they should have took more premium out of this side, but they're kind of like holding it right in there. Yes, that premium is 70 cents below that opening marker of that $16 low. That's the opening marker. You're 70 pennies below it, see? 16 and 15.30 on the bid. What the 90 asked, right below the 16 with the 16 penny spread. We just bought the put option at 14.60. There is the print. Here is the print. Here is the print, which we created the low of the day. The high was $19. And our first risk management entry is on the low of the day. Sorry, I didn't pay $19 over here. I paid $14.60. $15.40 being the low here, leveraging back up $5. They took it down $5, $4.90, and leveraged it right back up. Let me put it on pause. This was the opening bell, and MMTs, and the first part, you know, it's 11:30. We traded these in and out. We put a low in at 15.40 on that side and a high at 22. The actual processes that occurred during the intraday level here of the chart, where we broke higher, but then we broke down and we have broke back up. At one point, the put 540 put that was out of the money, it hit a high. So when we hit the low of 530, these went up to $19. Then when we contracted, they put in a bottom when we had these top reversals up here on Google and we went straight down. That's when we made the lows here, and they ticked right back up in value. And these came back down in value. So we're constantly trading the 530 call and the 530 put based on directional movement. We had the intraday low going into an hour and a half to the close. As of now, $13.40, so $19 on the high. They came down on $13.40. When they were coming down to $13.40, we had made a low over here on the 530 call. When we made a low right up to strike price, 530.81, it closed at 539, took it down $9 to the bottom, and then ran that thing to the all-time highs, and then we came back, and we did not want to break here. We came up, we tested teeny expansion at 37 cents a penny line, and we continued to break higher, and these continue to come down, and these leverage back up. So how do I get intraday trades here, and how do I get intraday trades here, and how do I use my platform to guide me wholeheartedly? and directional movement on a long side market calls and a short side market puts trading intraday.